Trump wants to reshape global trade. He promised to do it on the campaign trail at every stop. He said he was going to do it since he's been inaugurated, and yesterday he did it. And it goes to show you that the markets really aren't all that efficient, because I assume that the market must have been discounting that this was some kind of pre-negotiation bluff. And it very clearly wasn't. Whatever your views of the man or the policy or the wisdom of either, the fact that it is a surprise and the market has reacted so violently, I think speaks just as much about the market as it does the man's policies.
Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Most of you know me as Triangle Investor for social media. Today, we are joined by famous green checker Doomberg to talk about his area of expertise, energy, finance, and some geopolitics. You can find Doomberg on Substack and subscribe there. We will leave the link in the description of this video. That said, Doomberg, great to have you again in my show. Welcome back.
Lucian, great to talk to you, my friend, and congratulations on all your success. It's been fun to watch.
Thank you. Congrats on my side as well. You have a 4th-year anniversary, right?
Yes, we're coming up on 4 years completed of writing on Substack. It's amazing. 365 or 70 articles and 40 pro-tier presentations that we've put out. That's, when we first started, we thought we would run out of things to talk about, and the news has not disappointed, especially recently, which I'm sure we'll get into.
Yeah, let's kick off with that. President Trump declares Liberation Day, sweeping tariffs on goods worldwide. As expected, market tanked today with Dow Jones down more than, I believe, 1,300 points, 1,400, something like that. How are you viewing this tectonic move on the worldwide trading markets, and who will be the biggest winner and who will be the biggest loser from that?
Yeah, it's a great question. It's obviously the question of the day. And the first thing I would say is none of this should have come as much of a surprise to the markets if they had been paying attention to what Trump has been saying since as far back as 2023 in this series of videos that he published before the campaign really heated up called Agenda 47. Trump made it very clear that he basically, without saying it, wants to end the sort of the global trade architecture as it is currently designed. In his view, the US's role as the reserve currency and the sort of gatekeeper of the global order by necessity meant that over time, its own manufacturing base would be hollowed out, which is what has happened. And Trump, since the 80s, has been railing against this phenomenon, which, by the way, is when it really kicked into high gear. And for 40 years, the U.S. has been the supplier of the world's most dominant currency and global reserves. It exported debt. It sent paper abroad, and in return, it got real stuff. And so some would argue that was a pretty good trade. But if you're a blue-collar worker at a Midwestern manufacturing facility, the fact that many countries have more protectionist policies to, take care of their own domestic interests is seen as a huge disadvantage. And let's face it, the biggest elephant in the room and the country that matters the most is China. The U.S. doesn't make near as much stuff as it used to. It still makes a fair bit of things, and it also is very, very strong in energy, which is its saving grace. But Trump wants to reshape global trade. He promised to do it on the campaign trail at every stop. He said he was going to do it since he's been inaugurated, and yesterday he did it. And it goes to show you that the markets really aren't all that efficient, because I assume that the market must have been discounting that this was some kind of pre-negotiation bluff. And it very clearly wasn't. Whatever your views of the man or the policy or the wisdom of either, the fact that it is a surprise and the market has reacted so violently, I think speaks just as much about the market as it does the man's policies.
Yeah, good points. We are definitely living in challenging, I would dare to say, unprecedented times for energy, geopolitics, security, and more. The landscape is changing literally every day, every hour. If we look in the history, the energy, the commodities were always a tool in service of broader geopolitical games. So my question to you, to what extent are they a tool of power today for the world economic superpowers? How much are commodities and energy in service of shaping the world's order?
Yeah, they're always the most important commodity. And in fact, our view is that currencies exist to send market signals to energy transactions. And they just overlay such energy transactions in a way to try to make them, more efficient. And I think it matters that the U.S. is the, predominant global energy gigapower. I think Russia is in a very good position. We note with interest that there were no sanctions levied against Russia, predominantly because we've sanctioned them so much that we hardly trade with them, and the things that we do trade with them we need, like uranium and so on. But nonetheless, this is a purely economic decision. I don't think that one should read too much of geopolitical readout into what has transpired. And in fact, the methodology that was used to calculate the tariffs has sparked some controversy on Twitter because it actually doesn't seem as though it matters what the country's tariffs were. It matters much more what their trade imbalances were with the U.S. And that has basically been the formula that was used, much to the shock and chagrin of many of those who are most impacted by it. And I should say, your question was about energy. The U.S. is becoming more and more of an energy exporter, and it's difficult to put sanctions on energy because energy is so needed. And so I also note with interest that Canadian energy was exempt from the tariffs, which is a piece that we're working on for publication in a few days. We think there's a grand bargain to be had with Canada, and the nexus of Donald Trump and Mark Carney and Danielle Smith, the Premier of Alberta, is going to cause some changes in Canada that might lead to an unlocking of favorable energy flows between the two countries. There's no reason why Canada and the U.S. shouldn't be far more collaborative. Combined from an energy perspective, I mean, they're just unmatched. When you look at what's going on in Alberta and British Columbia and then the shale patch in the U.S., the huge uranium deposits in Canada, great nuclear technology in Canada and in the U.S. The two should really be working much closer. I think they will. I think this little spat was more about the political situation in Canada. But energy is always at the forefront of all of it. And I think Russia comes out of this quite strong. China is wounded. But we'll see how the market reacts. The other thing I would say is, I'm old enough to remember the global financial crisis, and I'm old enough to remember the COVID complete shutdown of the economy and negative oil prices. This too shall pass. The economy is very dynamic. It is a milestone. It is a very historic one. I think it's potentially could be on par with Nixon's closing of the gold window. Like, I don't want to minimize it. But the world moved on. There were consequences. Markets dealt with those consequences. Smart investors did well. Other people perhaps not so well. There was always winners and losers in every game. And our view is sort of to unemotionally assess the pieces on the board and try our best to play them in our own personal portfolios, and also, most importantly for us, to describe them as accurately as we can for our paying subscribers.
Yeah, that is the only right approach, if you ask me. So agreed. Doomberg, in our last interview, you said that energy markets are very well supplied, that there was abundance of natural gas, plenty of oil, plenty of coal. Did anything change in the meantime?
No, and in fact, we note with significant interest that OPEC chose today, of all days, to what we would call internally to step on the tape and to announce that they're front-loading increases in production, which has sent oil prices down hard, 7-8%. And I think our call on the energy markets has been quite good in the past couple of years. There's a lot of people who call themselves energy analysts, but are really energy bulls. They have a desire for energy prices to go up because they are invested in energy equities or the commodities themselves. And one of the things we try to do is to never be invested in things we read about. And there's two schools of thought in this business. One is, you want to have skin in the game so that you know that your research is, the impact of your research matters to your wallet. The other is, well, which is a view we take, if you don't invest in the things you write about, then you have a greater chance of not being impacted by your wallet. And by the way, our wallet is impacted every time we publish. If we get things right, we get more subscribers. If we get things categorically wrong all the time, then we will lose business. And so it does affect our wallet, but in a way, accuracy is what pays us. And this is the product that we try to create. And so I see online on Twitter, and we sort of call them wishcasters, people who are looking through the data to find reasons to be bullish, as opposed to looking at the data as it is and deciding whether to be bullish. And I think those are two very different forms of analysis. So as we sit here today, coal is under $100 a ton. There's a glut of coal in China. Very rational response. We studied China very carefully. China looked at the global energy crisis and decided it didn't want to live through that again. So it's keeping excess inventory of coal. If there's heavy rains, they switch to hydro and they stockpile even more coal. You have to understand how these markets work. They're interconnected, they're fungible. Natural gas in the US has perked up a bit, as we called in April, but it's still $4 a million BTU in the US. And landed LNG today, as we're talking, is $12.80 per million BTU US dollars. And if you look, that's basically the energy equivalent price of Brent crude. They're trading in tight correlation. And then the last thing I would look at is how many barrels of oil an ounce of gold buys you. That number keeps rising. If you assume that gold is the real money, and I'm assuming many of your listeners do, oil has never been cheaper. So there's nothing in the market. So here's like a classic chart that we look at every day. It is the price of Brent crude, landed LNG in Europe, natural gas in the US, and coal, all priced in dollars per million BTU. And when that chart is orderly and the things are priced where they should, coal is pretty cheap. US natural gas is much cheaper than LNG. LNG and Brent are trading for roughly the same price. That tells me that the market is normal. The market is balanced. There's no emergency. There's no crisis. And our view, last point, is that if you insist on trading the commodities, much better to fade price spikes that arise from temporary shortages than to try to time when they will arrive. Because crises have a way of working themselves out pretty quickly. All price spikes, we call them, Icarus prints internally. These price spikes inevitably fade. And that is a far better risk-reward trade, is to wait for such a crisis to evolve. A war with Iran breaks out and oil goes to 130. Absent a nuclear war, which who cares what your portfolio is, the price is going to be $60 in a year. Go out and buy a $80 put with a 9-month expiration, and you're probably going to do fine, right? These are the types of risk-reward trades that we would participate in if we were forced to trade commodities. Betting that there will be a price spike because of a shortage, because of geopolitics, is a great way to attrit alpha.
Yeah, you touched on gold. You mentioned gold a few moments ago. I want to continue on the gold topic. We have been entertained in the last few weeks with the speculation that there is no gold in Fort Knox, or not as much as expected. Do you believe in this speculation, and why do you think that this topic was now released in the public domain?
Yeah, that's an interesting one. In our view, it really is one of these sort of content-driven obsessions. People in the content world, and we're in the world, and you're always looking for things to write and talk about, can sometimes create a topic where there might not be one. But having said that, there is a potential rationale, which is a bit tinfoil, but I'll indulge in a bit of speculation. Our view is that the Trump administration is worried first and foremost about the refinancing wave, short-term bills that former Treasury Secretary Janet Yellen left behind for her successor to refinance. And they have been pounding the table that they want lower rates. One of the ways that they can reduce the refinancing risk is to create a mania in the crypto world, because most people's gateway into the crypto world is to buy a stable coin. And a stable coin takes US dollars and parks it in treasury bills, typically short-term treasury bills. because they want to capture the yield. That's their business model, and they need to have the liquidity to meet redemptions if people do exit the crypto casino. So if the integrated size of the stablecoin market increases by 100 billion or 200 billion this year, that's 100 billion or 200 billion less refinancing they have to do because they have a fresh bidder, i.e., Tether, Circle, and so on. And if in the overlap of the Venn diagram of reasons why people buy crypto and why they buy gold, there's a lot of cross thinking. We have many people who are hardcore Bitcoin people who subscribe to Doomberg, even though we are what they would call no coiners, because we have very similar thinking patterns, a distrust in the US dollar system, so on, so on, so on. And so, in a world where you want to shepherd incremental speculative dollars into the crypto universe, and I note with interest that Trump launched his coin a few days before the inauguration, and they've created this, crypto reserve. And they're passing stablecoin legislation, and the big banks are all getting behind it, and the ETFs are being approved. Maybe you want to cause doubt about the gold markets and create a little FUD in the gold world by saying, hey, maybe the gold's not there, gold's a risky asset, who knows what's going to happen, et cetera, et cetera. And so that's sort of a long shot explanation, but one that kind of perhaps sounds like it could be true.
No, it's a good one actually, and it's in line with my way of thinking as well. Doomberg, do you have in your models some expectations of the gold price? How do you view gold and silver performance in the next, let's say, 12 months? Is gold overbought? What do you think?
Well, we look at the world differently, and I think our mutual friend Rick Rule has spoken to this a few times. I don't view the dollar price of gold as the price of gold. I view the dollar price of gold as the price of the dollar. And I personally own a lot of gold, some physical, the rest manifested in Sprott Physical Gold Trust. And the reason I do is because gold is one of the means by which I save. And so our investment philosophy has three planks. One, we earn in fiat. We live in the fiat world. We pay our taxes in the fiat world. So we live in the fiat system. We have no desire to extricate ourselves from the fiat system. Two, we save by acquiring real assets like gold and land and collectibles. And then three, we invest privately where we can have some impact on the outcome to create our own alpha. So we don't speculate too much in the markets. And, you might dabble once in a while on a fun account with friends and things like that, but nothing serious. And mostly, I view gold as a saving. So 20 gold eagles will buy me a nicely trimmed SUV today, and it'll buy me a nicely trimmed SUV in 10 years, assuming we're still legally allowed to own such things.
Exactly.
And so I just view gold as a savings vehicle. So the price of gold to me is a statement of the world's belief in the US dollar. And this is how I view it.
Excellent. Let's move to uranium. In one of your recent interviews, I regularly watch your interviews. You said that uranium was fairly valued and that you don't see much reason for either buying or shorting it. I would like to hear your thoughts, your rationale behind that.
So, um, you know, and I think that the market has sort of stagnated from that point. It's drifted slightly lower, if anything else, just pulling up the chart as we're talking. Um, Uranium underwent what I would call an Icarus print, right? So for a decade, the prices, the decade after Fukushima, the price of uranium languished, $20 a pound, $30 a pound. A small but vocal and dedicated group of people on Twitter, Uranium Twitter, which is a great community and one that I respect, um, got behind the concept and they got paid. The Sprott Physical Uranium Trust came on the scene. We wrote about it. I think Copy did a pretty good job of putting it on people's radars. And we went from 25 when we first started writing about it to 108 or 110. And at those prices, there will be a supply response. And there's a few more nuances in the market because, of course, it's enriched uranium that actually powers nuclear, and we're all trading in unenriched uranium. After you see such a print, as I just said earlier, The best trade is usually to fade it. Now, by the time the interview was recorded that you heard me say that last time, it had already faded $30. And so, you know, 25 to 30 was not an appropriate price to ensure adequacy of supply in a world where nuclear is growing. 65 to 70 probably is. And so at $100, you're bringing on all manner of marginal properties and, recycling and pick your favorite, responses. There's always a response, right? And so again, our view, learned the hard way over the years, is that you have to fade super spikes. And at a minimum, you should take profits when those opportunities present themselves. And nothing goes up forever, right? And so if you have an extended period of $60 to $70 uranium, which is above the sort of cost of capital for the crossing point on the uranium supply curve, then you will see a stabilization in the market. That's the thing about trading commodities in the long term. Arbitrage has a way of working itself out. And so I reiterate our call that there's nothing particularly exciting about the market that would cause us to feel like we would have to take a position. Now, when natural gas got down to $1.50 in April of last year in the US, we came out with a call saying that, this is, if not the bottom, it sure feels like the bottom. And reasons in a piece called Generational Arbitrage, the oil to gas ratio got so far out of whack that it felt like the jaws of arbitrage had to close. And they have. Uranium, there's no screaming market imbalance or mechanism to close it. And I think the turning point in that sort of bubble was when the Sprott Physical Uranium Trust was denied the New York Stock Exchange listing for the product. And I think the air kind of went out of the balloon of that trade. I haven't looked in a while, but it's basically a closed-end fund at that point. It's not like you can redeem for radioactive uranium. And so, it can trade at a discount and so on. And so there's lots of reasons why investors would get frustrated and just take their money elsewhere.
Yeah, interesting take. Building nuclear power plants was never cheap. How are the costs looking today? I mean, will the world have money for nuclear renaissance? We have at the moment 440 reactors in operation, 64, 65 under construction, 80 or 90 planned with more than 300 proposed. Will the world have money for nuclear renaissance?
The cost of nuclear is almost entirely a political choice. How much regulatory scrutiny will you impose? How long will it take to get permits? How bankable is the project? The longer it takes, the less, the more cost, because you have to fund, with today's dollars, future expenses. And in China, it's very cheap and manageable, and they're building a wave of them because they have chosen to make it cheap and manageable. Standardized designs, strong government support, no environmental protest movement suing at every opportunity to stop things. So I think we will see a nuclear renaissance. We are seeing a nuclear renaissance. Part of the nuclear renaissance is going to be picking off the low-hanging fruit, like a full Japan restart and so on. And there are opportunities to restart closed reactors in the US, and there's opportunities to put additional reactors on sites that were designed for more capacity than they currently have. Building a completely new, greenfield nuclear power plant in the US is probably still cost prohibitive and takes too long, but that's a political choice. If we decided as a country collectively that we shall embark on a nuclear renaissance, we could easily do it. France did it in the 70s. Canada did it. I mean, we've gotten dumb in 50 years? No, we just gotten regulatory morass and bureaucratic inefficiencies that have crept into the system. And so China doesn't suffer from that. They build things quickly when the CCP decides to get behind something. And so we will see, just between the sort of restart of Japan and the build out of China, substantial growth in nuclear. But the market, the uranium market, for example, is discounting all of that. It sees the same thing we see, especially in a post sort of blow off top market where lots of people got excited and got into the market, which, by the way, no fault to any of those. It's always exciting to participate in an updraft like that. knowing when to leave the casino is always the hard part. So, but yes, I think there will be a renaissance. Many such plants will get built. We'll see what happens in the U.S. But yeah, I'm still bullish nuclear. But when I look at how uranium is trading and what it's currently priced at, I don't have a strong opinion either way on the direction.
Got it. I got a question from one of my follower where he asked about the water constraints in relation to the data center build out. Do you see water scarcity as an issue in places like Permian Basin? And if yes, what are some good ways to play that theme?
Well, I mean, there's a lot of produced water in the Permian, and I'm sure there's lots of, you know what I mean by produced water. Of course, they're drowning in produced water, and in fact, in many cases, it is a constraint to production at some point. Um, Data centers are all about the physics of cooling, and there's a huge amount of science and technology investments being deployed against the problem. One of our views is that we will co-locate data centers basically right on top of natural gas wells, and you will have natural gas going in one end and data coming out the other. And a great place to do that would be, say, in a cold place like British Columbia or Alberta or Alaska, because you have the inherent advantage of the environment surrounding you is not very warm. So, you know, data centers basically are giant cooling projects, and water is a coolant. There are other ways to cool things. There are innovative things being discovered, and the technology will work itself out. The market will work itself out. I don't think um, water shortages will limit data center proliferation. I think local water issues will dictate where data centers go, if that makes sense.
Yeah. Doomberg, can you make a list for me? Let's say three commodities that you believe will outperform in the next 12 months and three commodities that will not perform so well, in your opinion.
Yeah, so I would say that if I look at the board today, the cheapest natural gas in the world is in the Permian and in Alberta, British Columbia, because it's trapped. And so those really can only go up from here. I mean, they could go down, of course, they can be negative, but everybody sees the problem. Innovators are working on unlocking the solutions. So I would be long stranded natural gas in North America. I would also be long LNG pretty close. You know, there's only so cheap it can get. If natural gas in the US becomes slightly more expensive because of the AI boom, LNG will have to compete for those molecules. And I think the market is potentially underestimating the European gas storage situation, which is a real scandal in my view. And if we have a cold winter next year, it's going to be very interesting. But the refilling season, you know, they're exiting 2025 winter at dangerously low levels, I think in the very low 30% storage of capacity. The next winter, they won't have the natural gas that was flowing through the pipelines through Ukraine, for example, to rely upon. They do have increased flows through Turk Stream, but Europe is one sabotage attack on Turk Stream or Blue Stream away from a true energy crisis again, and you could see LNG prices spiking. So on a risk reward basis, I would also be interested at the, you know, the JKM or the TTF contracts. And then bearish, I would be bearish crude oil. I think Donald Trump wants $50 a barrel. I don't know why people don't listen to him. We've said while he was running that the Republicans, the energy executive supporting him, will be disappointed because he is going to be bullish for supply, bearish for price, which is bearish for equities. And he's living true to that. I note with interest the rumblings about Chris Wright not being, quote, our guy, but Trump's guy. Yes, he works for the president. The president wants lower oil prices. Again, the fact that OPEC stepped on the tape today to push oil down, you know, 8% is interesting to me. It sounds like a deal was cut. I think who knows what's going on behind closed doors between Russia, Saudi Arabia, and the U.S. I note with interest the three of them are collaborating on trying to solve the Ukraine crisis, and the three of them happen to be the three largest producers of oil in the world. And so any peace in Ukraine is bearish oil. Any sanction relief on Russia is bearish oil. And the glut of natural gas is bearish oil. And I think actually we made this call last year in a piece called How OPEC Ends. OPEC is teetering. Um, Dirt cheap natural gas co-produced with oil in the US is undermining oil. And the reason why we're still producing so much gas in the Permian is because oil is artificially expensive. And so the artificially held high price of oil is the economic motivator to flood the world with natural gas, and people are switching engines, which is inevitably what happens. And once an engine switches, once a long haul truck in China goes to LNG instead of diesel, that diesel demand is lost for the life of that truck. And so we're seeing that, which is, again, another thing that we've been writing about for 18 months, starting with a piece we wrote last year called Pea Cheap Oil is a Myth. People don't understand how energy works. Last thing I'll say, certain people on Twitter who would call themselves energy experts, but are actually just energy bulls, make the case that, natural gas liquids don't count. Crude oil production in the US is flat. They don't know what they're talking about. Of course, NGLs are oil. They're used for the same thing. An ethylene cracker that switches to ethane only displaces naphtha in Europe, and that naphtha goes back into the oil flows and causes prices to come down. Like, yes, dirt cheap ethane in the US hurts oil prices. The connections are there. We talk about them in all of our Doom Zoom Pro Talks. And people just don't want to see them because they're looking for reasons to be bullish. So I would be long stranded gas because they have to eventually get released. Western Canada, the Canada LNG project will come online. Other ones will be announced. And then I would be a bullish LNG just because of the potential for a crisis, although that's not how we like to invest. And then we would be bearish oil relative to natural gas.
Okay, thank you for that. Final question, Doomberg. I know it's not your specifically area of expertise, but do you see a danger of banking sector collapse? And could that be a trigger for a wild financial reset? Or something else? What do you see as a trigger for wide financial reset?
I think we're going through a financial reset right now in the form of a complete reordering of global trade. So who knows? That is a shaking of the magic 8 ball, and we don't know what the message will be when you stop. But to your specific question, no. I think that we made a call in a piece called "The U.S. is Not Broke," that rates were coming down. The 10-year was at 4.60 when we made that call, and I see it's at $4.03 right now as we're recording this. That's a big move for the 10-year. The Treasury Department wants rates lower. Don't fight the Fed, so to speak, broadly, the federal government in this case. And the lower interest rates go, the healthier the banking system is in a way, because bonds and their reserves are inversely, the value of their reserves is inversely correlated to the level of interest rates. And so if a spike in interest rates is what caused the sort of Silicon Valley Bank failure type, because they did a poor job of allocating the reserves with respect to duration, falling rates has to be healthy for banks. And so I don't think that's a major concern at this point.
Okay, Doomberg, how can people reach out to you?
They can find everything at Doomberg.com. Nice and simple. We have our articles there. We publish between 7 and 9 articles a month. Our Doomberg Pro tier, where we publish, in addition to those articles, a detailed, usually 45 minutes to an hour long presentation once a month on topics of interest. All of our podcast appearances, like this one, are also linked there under our Doomcast page. So yeah, it's great to talk to you again, my friend. Looking forward to the next one.